Welcome to our business tax revision session. We're going to have a look at task number 1 and in particular the adjusting of accounting profits and losses for tax purposes. We're dealing here with Finance Act 2023, so this is relevant for all assessments sat during the calendar year 2024 and into January of 2025. So let's have a think about task number 1 then and what that might involve. The first task of the business tax assessment is always going to be on adjusting of accounting profits. So we've got to be able to take the profit from a set of accounts and be able to adjust it to make it into a profit that the tax office are going to be happy with and happy that it will form the basis of our tax computation. So if you're new to these revision sessions or new to the FI materials, you'll find that at the beginning of each of our tasks within this revision mock, it's actually our first intuition mock number 1, you will find a task briefing. And the task briefing gives me, firstly, an idea about what the task will cover. So as I just said, it's about adjusting of accounting profits and losses to make them suitable for tax purposes. Also tells us that the task is worth 8 marks, meaning we get about 9 minutes in the exam to do it. The task briefing then follows, and it really just gives us a bit of a technical recap on some of the facts that are necessary in order to be successful with task 1. I'm not going to read through all of that now, but if you do feel a little bit lost having watched this lecture, or it just prompts you to think there's actually quite a bit more I need to know about that topic, then I definitely recommend having a read through the task briefing, which is actually just an abbreviated version of our full course notes related to this particular area. So they do run through how we adjust profits. As you can see there, quite a long list of things we need to know about. And then it mentions there is a table of disallowed expenditure in the reference material that we ought to be familiar with. So let's have a look at that. It's here. The reference material, if you remember, is provided to you throughout the assessment through pop-up windows. And this is section number 6 of the reference material, headed up disallowed expenditure. And as you can see, it shows the type of expense over on the far left. So for example, fines and penalties. And it tells me fines on the business, or in the case of a company, fines on the directors or owners of the business are disallowed. With a note to say, if it's an employee fine, it won't be disallowed if the fine was incurred in the course of their employment. So if the employee was sent on an errand, and as part of that errand they get a parking ticket, for an example, or even a speeding fine, and the employer pays it for them because they got the fine while they were doing their job, then that is actually allowable and can just be included in expenses as normal. If it is a fine on the business or a fine on the director or owner of the business, it is disallowed. You can imagine that HMRC are not too keen on giving tax relief for fines and penalties. So that's why we disallow it. So do make sure you are familiar with the reference material, knowing what's included and knowing what isn't. Because anything not included in the reference material you have to learn, but there is quite a lot there. So I think making sure you're familiar with the list is a really great start. So we're going to move on past our move on past our task briefing here and get into the actual task itself. So here is our example task to practice, testing our understanding of task 1. It's for Susan's sole trader business, and Susan has prepared the following statement of profit or loss. So this is her accounting profit or loss statement. We need to adjust it now for tax purposes, going through it line by line, see if there's anything in there that shouldn't be there, and if there is, of course, we're going to remove it. So it starts from gross profit, which suggests there's nothing up until that point that's going to cause us an issue. And as I go down the list, I see she's paid out some wages and salaries. No issue with those as far as they are legitimately reducing the gross profit figure. Don't want to make any adjustments there because there's no notes to go with it. There's no notes to suggest there's anything in there that's at all unusual. So I go to the next line, accountancy and legal costs. And when I get to that line, I see it's referenced to note 1. So let's have a look at note 1 then. Note 1 includes an annual audit fee. Well, there is absolutely no problem at all with Susan having her accounts looked at professionally at the end of the year. So I don't have an issue with Susan's accounting or audit fee, in this case £18,500. So I'm not going to disallow that one. I'm not going to do anything with it. It's been included within expenses and I think it should be. So I'm just going to leave it exactly where it is, within this expenses figure here. A legitimate expense, I don't need to do anything with it. However, the legal cost for a tax appeal, this is now where there's clearly been an estimation of tax by HMRC, and they've said to Susan, this is what you need to pay. And she said, I'm not happy with that. I'm going to get a solicitor and I'm going to appeal against the tax that you're asking me to pay. So, of course, HMRC are not very happy. They now have to deal with this appeal. So they're certainly not going to give her tax relief on the cost of telling them that they're wrong and that she wants to pay less tax. So that certainly is going to be disallowed. That simply means we're going to add it back on to the profit figure. So where the profit figure in the accounts is here, we're going to say that expense shouldn't really be there. So I need to strip 6,650 out of my expenses. So I effectively add 6,650 on top of the profit. Because if I had less expenses, I'd have more profit. So I'm going to add that one back. Motor expenses come next, and again, if there's no note to go with it, I've got to assume they're absolutely fine. Repairs and renewals do have a note attached to those, so let's look at that one. 86522, and I learn within repairs and renewals, there is a redecoration cost. Decorating, not a problem. Redecorating suggests we've decorated before, we're now just decorating again. So that's just part of repairing or renewing our offices or our business premises to keep them up to an appropriate standard. So I'm quite happy with decorating or redecorating. No issues there. I then have the installation cost relating to a new item of machinery. So now when I buy my machinery, let's imagine I am going to do the double entry for that. So if I'm paying for it cash, I'm going to credit cash and I'm going to debit new machine, or machinery if you like, an asset in the statement of financial position. But when I put that asset into the statement of financial position, the cost of it should include the installation. So I should actually include that as CapEx. It's all part and parcel of buying a new asset and getting that item installed and working and able to start adding value to the business. So it's not what we'd call a revenue expense, it's a capital expense. So I'm going to disallow it, which means I'm going to say that there is 6,500 of expenses in the profit and loss that shouldn't be there. And again, I'm going to add those back on the basis of making the profit bigger and of course then collecting a bit more tax. That's another disallowed item. And what we probably ought to do as we go along, just so we don't lose track at the end, is in our pro forma here, where we are going to calculate the taxable trading profit for Susan, we are going to start adding back the various things that we've discussed. So the audit fee we said was absolutely fine, so I don't need to do anything with that one. We said we would add back the tax appeal. I think that was note 1. Redecoration we said was fine, but we will now want to add back the cost of installing our machine. That was in note 2. So having the effect of increasing the accounting profit to turn it into a tax profit, disallowing expenses that don't meet with HMRC's criteria of being allowable. Okay, what comes next? So we've done motor, nothing there. We've done repairs and renewals and stripped out something from there. We've then got office expenses. Don't have any issue with that. There's no note to go with it, so I'm going to make an assumption. Everything's fine. Depreciation, there's no note to go with that one either. But I always add back depreciation, don't I? I use capital allowances instead. So depreciation must be added back simply because the taxpayer can choose their own depreciation policy and HMRC don't really like that. So they want us to add back all the depreciation, increasing the profit by the depreciation amount. And you can see a little bit later, we get what we call sometimes the tax adjusted depreciation. This is just like the tax office version of depreciation. We call it capital allowances, so we'll get to that a little bit later. But we do add back depreciation, but we then allow a deduction for capital allowances when we get to them. So we've done that one. Then we've got other expenses from note 3. Let's have a look. We've got customer entertaining. The reference material could possibly help you out here. Entertaining and gifts. It's headed up disallowable. And under entertaining and gifts it clearly says customer and supplier entertaining. So all the customer entertaining, in this case, the full 8552 is not allowed. I need to add it back on. So let's go to there and let's get it added back on. And the thing I like about these style of questions is it's lots of individual little things. And every one I get right, I'm getting credit for. So even if I miss one, I can still score really well on this type of question. We then got food hampers given to staff as gifts. Staff gifts are absolutely fine. We don't have an issue with those. Again, we can flip back to the reference material. And there is a little note here about gifts, but it says customer gifts. It doesn't mention staff gifts. Staff gifts mentioned here and staff entertaining are allowable. Not a problem. So there's no adjustment for the staff gifts at all. The next thing in the question, though, then it refers to bottles of wine. And these bottles of wine include a company logo, which maybe rings a bit of a bell for you, and they're given to customers. So you're thinking, oh, okay, I do remember something about that. So let's check our reference material for this. It says customer gifts are disallowed unless they cost less than £50 for the year for that particular customer. They are not food, they are not drink, and they are not tobacco, they're not cash vouchers, and they must contain a business advert. So this gift does include a business advert, so it certainly qualifies in that respect. I don't know what it costs because the question doesn't tell me, but I do know that it's drink. And because it's drink, it fails on that hurdle. And I have to get through every hurdle in order for it to be allowed. So costing less than £50, not food, not drink, not tobacco, not a voucher, and have an advert on. So as long as it meets all those criteria, it's allowed. If it fails to meet any one, not allowed. So a corporate diary or a calendar or a pen, all of those things are absolutely fine, but drink is not. So that will need to be added back on. So let's go back to our question. And the bottles of wine were 5,580 and we're saying not allowed. Food hampers were fine, so the wine was not. And the next bit, donations to a local charity. Donations to local charity are allowed as long as they're a small donation and it's to a local charity. So I have no issues with that one. I'm going to let that one go through. So no adjustment needed there. It does mention it here. Disallowed, donations to national charities and political. Donations to local charities are allowable if you are a sole trader. They're not testable for companies. Oh, sorry, wrong one. Okay, so that one's fine. So I'm not going to add anything back for that one. And then I've got capital allowances. They're the tax version of depreciation. So depreciation is added back and I get these instead. So what I'd then be looking to do is add down the statement, starting with the profit figure that I was given per the financial accounts, add back on all the expenses that I'm saying are disallowed, and then knock off the capital allowances at the end there because they are allowable. And that gives me a profit for tax purposes. So a little bit different to the profit that the sole trader was reporting, which is the whole point of the exercise. This is now the profit according to the tax legislation. This is a profit that I need to be including in my tax calculations. Okay, part B of this question then just says a few more things. Let's just test these specific things. 3 marks. Is this something that's allowable? Is this something that's disallowable, which means I have to add it back on, such as the bottles of wine, the entertaining. So I've basically been adding back all my expenses. So I add back expenses that are not allowed because they have had the effect of reducing the profit. And I'm now saying you shouldn't have included that. It's not okay for tax, so we need to add it back. So expenses that are not allowed would be added back on. Things might be disallowed but then deducted. So I've just got to think about what they would be. That would be income that is not allowed. So I'm saying it shouldn't be in there, but because it's income and I'm trying to strip it out of a profit figure, I'm going to deduct it. So before I get myself in a muddle by reading through the options in a question like this, I would clarify that in my own mind. So allowable means don't need to change it, perfectly valid. Disallowed and add it back, it must be an expense. Disallow it and deduct it, it must be an income. So let's look. Profit on the sale of a factory. Perfect example. If I did have a profit on the sale of a factory, that would mean that the accounting profit that had been provided would include some profit from the sale of that factory. And it shouldn't be there. So I then need to say, okay, I need to get it out then. How am I going to do that? I'm going to deduct it from the profit that's been reported. So it's disallowable and it's deducted. Food hamper for a customer. Well, we talked about food hampers and we said not allowed. Food hamper for the staff was absolutely fine up here, but if it's for a customer, not okay. Not food, not alcohol, not vouchers, none of that is allowable for customers. And then finally, purchase of computer equipment. Again, not allowable. We're going to disallow it because it's capital expenditure. We'd allow the capital allowances, but that's not what the question is asking us. So we need to disallow the cost of the computer itself. So there we go. That's our review of task number 1. If you found that useful, then you might want to join me as we head into task number 2 next.